Well, welcome to Compound Thesis. Super excited. Today, our guest is Seth Ginns. He's a managing partner and the head of liquid investments at CoinFund. Welcome to the show, Seth.
Thanks for having me, Jim.
It's great to see you. So, before we kind of dive into CoinFund, I know, you spent 2 decades, not three, at at Jennison, which is one of the top fundamental investing shops in large cap kind of equity space. What got you excited about crypto or blockchain in generally, and what made you kind of focus on this space exclusively?
Yeah, so I read about Bitcoin back in 2011 and in the New Yorker, funny enough, and there wasn't a great way to buy it at the time. You just had to wire money to Mt. Gox, and I thought that was a little shady. But then in 2012, I was doing startup investing, and this was all just like PA. And I saw deal flow out of Y Combinator, and I saw Coinbase, and I was like, this is like the compliant way to buy Bitcoin. And bought actually did a seed investment in Coinbase, and then bought some Bitcoin on Coinbase, and that was my start in the space. And then for the next 8 years, I did a bunch of other angel investments. Once you make an investment in a space, then you're like, it's easier to like follow it, stay in the loop on what's happening in that area. So saw like, what was happening in ETH and got engaged there and some other startups. And my view was always, if and when this becomes an institutional asset class, I'd want to be ready to launch a fund. Saw that coming together in 19. And the rest is history. I had known the CoinFund guys from the New York ecosystem. And when I was going to crypto events, I was seeing allocators. The last bull market, there was this whole theme like the institutions are coming, but like the institutions didn't all come at once. Like they went up a learning curve, and back in like 19, we started to see some really big institutions saying, I want to learn about this space. I think this could be real. And it was usually like an analyst who was super passionate about crypto. And that just started to build, and then I joined CoinFund at the beginning of 20.
So I think you tried to launch a kind of digital asset strategy at Jennison right before you fully transitioned over into CoinFund. Can you tell us like what that experience was like?
Yeah, that was actually, it wasn't right before. That was back in the summer of 17.
Mm.
But it's really funny. I remember Ari Paul doing a podcast where he was talking about how they custodied their crypto, and he was like, we have this air gap laptop, and then we put duct tape on it, and then we splash nail polish on it and take a picture so we know if it's tampered with. That was not like institutional speed. So the big difference between the summer of 17 and 19 was seeing institutional grade custody come into play. So Coinbase custody, Fidelity was doing it for Bitcoin, but not a broader set of assets at that time. It was seeing the derivatives ecosystem come into its own with CME, CBOE starting to get some volumes. By 19, I think CBOE had dropped out, but CME was starting to see more activity. So it was all of these different elements of what you would need for institutional engagement coming together that 2 years earlier we didn't see. But what's interesting is it kind of the bull market in 17 with the ICO boom. It led to a wave of capital, a wave of builders, and you planted the seeds for the next bull market very much in the same way that what we saw over the course of 2021 and really through 22 has planted the seeds for this next bull market, which we think we're in the early innings of now. So this is like a tried and true path in crypto. The cadence of innovation is really high, and you get a price move, which then leads to developers, then leads to capital, and then that ends up planting the seeds for your next bull market. And that bull market can be because the tech is amazing that's developed out of that, or the bull market can be that you've built a lot of really important infrastructure, which then allows for a new set of entrants. In the case of the 2020 through 22 market, institutions to come in a big way.
Yeah, so it's interesting. I mean, these cycles continue to repeat, and for somebody that's been in investing for a long time, probably some idiosyncratic factors that drive the bull markets and the bear markets in crypto. But as you're seeing different trends, and we'll get into kind of your thoughts as to where we're heading from here, but it is positive to see, despite the price action over the last, couple of months, certainly has not the organic, growth numbers underneath the hood. If you look at developers and all of the infrastructure that's being built in this ecosystem, the talent and the capital that keeps coming this direction, seems like it's planting the seeds for that next stage of growth. And so we'll get into that. But I wanted to pick your brain a little bit more on CoinFund itself. So, can you talk a little bit about, your role there and kind of what makes CoinFund unique? I know it's kind of like a crossover strategy where you have, seed, venture, and liquid strategies. So if you could give us a little bit of breakdown as to the firm and specifically what you're focused on would be really helpful.
Yeah, so we look at CoinFund as being the premier crypto investment platform. We have activities across venture and liquid, and we were started back in 2015 by my partner Jake, who's an engineer.
Mm.
He was out in Brooklyn, saw the development of the Ethereum ecosystem. He was like, I want to find a way to support this. And we had a small friends and family pool of capital, and that really got everything going. That was well before my time. What I love to point out about when Jake started CoinFund is the fact that it wasn't when Bitcoin was at an all-time high. It was actually the all-time high was November of 2013 with Bitcoin at 1100. It was right around Thanksgiving.
Hmm.
When Jake started CoinFund, it was the depths of the bear market. It was like Bitcoin $200, and it was about the tech. And the tech has been a guiding light for CoinFund since then. I think what's really interesting and differentiating is as we came into the cycle when I joined. So I joined at the beginning of 20, and I'm one of the managing partners at the firm. Um, we kind of said the institutions are getting ready to come, and now is the time to aggressively reinvest in building out institutional grade infrastructure. So saying in a few years, if this is an asset class that institutions are engaging with in a material way, both on the venture side and on the liquid side, what are they going to need from a controls perspective, an infrastructure perspective? And we really started to hire a lot on that front at the beginning of 21. We always kind of had that mindset, but then building out whether it was on the liquid side, a head of trading ops, who both come from traditional finance, whether it was our CFO, our president, Chris Perkins, who came from Citigroup, really focused on making sure that we're bringing best in class infrastructure, ideas, controls from the traditional finance world, but then also having a very crypto native approach as well. From Jake's background from the early days of crypto, my partner Alex Felix also early in the space, my background going back to 2012, and then the broader investment team having been engaged for a long time. So looking across venture and liquid, doing it in a way that really takes the best of crypto native and traditional finance learnings, and is thinking about not where crypto is today, but where it's going as an investable asset class over the next 5 years, 10 years, 20 years.
So with the private and, I guess public arms being your venture and the liquid strategies, how do those two, work side by side, or how does the strategy in one inform the strategy of the other? Could you talk through, because the crossover funds are very popular in traditional equities, right? If you look at the Tigers and the Cotus of the world, that have a venture strategy as well as a public equity strategy, oftentimes looking at the same sectors, there's a lot of, uh, there's a lot of overlap between those two, and they tend to inform each other. So curious if that works similarly if you're very close with your venture partners from the liquid strategy perspective.
Yeah, no, we think what's cool about crypto is there's a lot of information available out in the public domain, but it's like drinking from a fire hose. So having, and if you think about a lot of areas that we're excited about today, whether it's zero knowledge rollups, whether it's data unions, whether it's ETH scaling more broadly than ZK, whether it's cross-chain interoperability, there's a lot that's liquid,
Hmm.
and then there's a lot that's still not liquid, but that's live and actionable, and you can play around with the tech. And there are lots of views out there in the public domain. So we think it's really powerful to have this combination of people who are looking at what's happening in the part of the universe that's still not tied to liquid tokens, as well as the liquid token part, and providing that full waterfront view to help inform where the competitive landscape is going to be over the next year, 2 years, 3 years, and try to have a well-informed view about which competitive advantages are going to be more resilient, and which might be subject to new competition, and greater competitive forces. So we really like having that view across the waterfront, and have analysts that spend time looking across both liquid and illiquid, and contributing ideas, thinking about strategy and tactics across both areas.
Yeah, I mean, the ecosystem continues to evolve, but on the liquid side, you could still look at a lot of those as early stage startups, just with more of a liquid investable asset, I guess, behind it. But certainly having a visibility across the entire ecosystem, regardless of stage, gives you a really good seat at the table to figure out where to invest, but also how to advise portfolio companies as they think about their strategic priorities and also potential opportunities. I guess one other thing too, you mentioned CoinFund. The genesis was really a bunch of friends that were getting together. I'd imagine that your LPs look a lot different than they did a couple of years ago. Can you talk about conversations or just the evolution of your institutional allocator relationships, and kind of where things stand today and where you see them heading?
Yeah, so early coin fund, as I noted, what was a bunch of friends and family, and a lot of those people were early developers in the space, early founders. If you look at where our LP base is today, it reflects the fact that institutions have started to come into the space a lot more. I think we were public about some of the LPs in our venture fund that we raised last summer. Those are some of the biggest institutions out there, like Texas Teachers, that are very much interested in the space, see it as an emerging area of tech that they want to stay close to. I think all of the big institutions are coming in a measured way, but that's really similar to when you think about how I described my start in crypto a decade ago, getting a few investments in my PA, and having that be a reason to following it more closely, and really drive a deeper understanding of what's happening in the space. So I think it's really healthy at any size at this point. What's really interesting is we get a lot of questions around how everything that happened with FTX impacted institutional interest. And we certainly have seen some institutions say, look, we were getting there, and now we're going to slow down our pace of engagement a little bit. I'd say there was more of that in November and December of last year. What's really interesting, though, is at the start of this year, even before we started to see prices move higher, we were having meetings with institutions where they were saying, we're starting to get really excited about valuations, particularly on the liquid side, but also on the venture side. And one thing that's been in common, there were multiple institutions that kind of look quite different. So from foundations to an endowment to sovereign wealth funds, that were making comments like that. But the thing that they had in common was they had all already owned some crypto through a cycle. So they weren't brand new to crypto saying, okay, now we think this is the right time to start dialing up our engagement. They had either been involved on the venture side through a cycle, been involved on the liquid side through a cycle. They had met a lot of teams, met a lot of investors, and they were comfortable saying, we've seen what this looks like, what a cycle looks like. We're actually willing to make the bet this time that this cycle is going to be shorter than prior cycles because more of our peers are tuned in to what's happening here. This is this is a very different environment for crypto for this drawdown than what we've seen in prior cycles. So they're kind of familiar with the space and they're primed to try to engage at the right time cyclically, which is really interesting.
Yeah, I mean, it's amazing how, I've been in this space now for call it 9 months, as an operator. I've been an investor for a number of years, but watching the timelines are so compressed in this space, whether it's the cycles that you're talking about or even just innovation. And so, when it was November and doomsday was kind of on our front door, and all of a sudden here we are in February, a lot of the uh, that has really shocked, I think, a lot of people, is how quickly the space has rebound. And I think a lot of it has to do with your point of the last number of years really built a strong foundation of developers in the ecosystem, and the technology and the institutional adoption, regulatory involvement, um, globally, just creates a much stronger foundation. And we're seeing that in the price action as well. And so it's very promising to hear that on the allocator side that they're also noticing that as well.
We did a presentation a few weeks ago, and one of the things that we pointed out was, so Electric Capital had a great developer report, 297% growth in monthly active developers from the peak of the last bull market in 17 to today. 5% growth over the course of 22, despite prices being down a lot, and that's the lifeblood of the industry, right? That's what's sowing the seeds for the next bull market. And I remember when I was on the equity side going in to talk to a prominent venture firm, and around the table we had a bunch of the largest equities investors in the FANG names. And they said, what should we be watching for disruption to our large shareholdings in the big tech names? Without missing a beat, they said, crypto, blockchain. We follow where the best developers are going, and we see this stream of developers coming in. And that was right around that end of 2017 level, because it flattened out in 18 into early 19 when I had that meeting. So we've had really material growth since then. But what really drove the last bull market was the building and the capital that came in from that 2017, 2018 cycle. So really, really exciting stuff. And I think the institutional investors that have come in see that. It's hard to not see that and be excited about it. So yeah, we're feeling good.
When you highlight that, call it 5% year over year growth, I guess in 2022 for developers, is that in any particular ecosystem? Do you kind of break that out, or did Electric break that out in different, L1s or L2s or different spaces that you find where the most developer activity is heading?
Yeah, they broke that out, and there's some dispersion, but it generally leans to the places that you would expect. And look,
Mhm.
you don't bet against the ETH ecosystem. Very strong developers, very good network effects among developers and projects, but some very good growth outside of ETH as well, and particularly for our venture activities. Really excited to see where developers are interested, where they're engaging, and there's going to be some movement that happens when you have a year like 2022. So we'll see what that report looks like at the end of 23. But there's a willingness of developers to explore new ecosystems. But then there's also a lot of excitement around what's happening on ETH and the continued build out of ETH activity and the ETH tech stack, and EVM as well, of course.
So as you look at, I guess the price action is, somewhat reflected that organic, growth, but also, liquidity has come down quite a bit given, the collapse of exchanges and, the credit cycle that also blew up. Can you talk a little bit about what you're seeing in terms of volumes and any interesting insights that you guys are tracking there? And imagine that, you guys are very fundamentally driven in your investment process, but the market structure and the macro factors also play into how you think about managing your portfolio.
Yeah. So one of the questions that I get pretty often right now is you've had a lot of the big lenders in the space go out of business or pull back on their lending activity. So where is liquidity going to come from? And you've also had some big market makers step back their
Sure.
activities. What's interesting though is this isn't that different from what we've seen in prior cycles. You always have liquidity recede as the market goes down, or when you get toward the trough of the bear market. You always have a lot more liquidity at the peak of the bull market. And I think one of the things that's been very encouraging for us in this bear market, and we started to see this in late June, early July of last year. We actually came out with a call last summer that we were seeing some signs of a bottoming process, and this was one core component of that. It was that you started to see fundamental catalysts paid for in the market.
Hmm.
And it didn't really matter if liquidity had receded from a particular corner of the market. If you went through a fundamental catalyst, so think like ETH before the merge, having some of its test nets go through merges. Um, think the more recently the pull forward of the Shanghai upgrade and what that's done for liquid staking derivative protocols. In a bear market, good news is bad news and bad news is bad news, right? In a bull market, you start to get rewarded for good news, and we started seeing that over the summer. There were a bunch of names that didn't go to new lows on FTX. In fact, ETH held its low from the summer while Bitcoin broke down to a new low. In our view, that's because ETH went through one of the biggest technical upgrades the space has seen with the merge going very successfully in September. And even though it didn't perform well right after the merge, the fact that it didn't go to a new low on FTX was a really strong sign that the market was pricing in more value to ETH as a result of it having gone through that fundamental catalyst. And then there were a number of names that actually have outperformed ETH since the summer as well. So I look at it as yes, these like macro liquidity waves come and go, but there's still enough fundamentally driven liquidity in the market, even as early as July and August, but certainly today, where you'll see fundamentals priced in relatively effectively. Is it efficiently? I don't know, because it often takes a little time. Like, you'll have the catalyst and it doesn't get priced in immediately, and that's a great opportunity. But
Sure.
we're seeing enough fundamental investors bring capital to the space and engage based on real fundamental developments, such that it doesn't matter if that macro liquidity has receded significantly. It does matter when you think about how big funds can get in the space, when you want to be able to do proper risk management, and I think there are varying degrees of ways that funds think about that liquidity and what it means for their capacity broadly within crypto, within active crypto. Same thing for quant funds, where they need to think about those dynamics, and liquidity means they can't engage as aggressively. But what I think about just at a high level is, are we seeing fundamentals priced into the market? And we've seen that since the summer. Before that, we actually were not seeing that be the case.
So on the fundamental point, what types of metrics are you actually looking at aside from developers? Are you looking at TVL? Are you looking at number of wallets, like number of addresses, or just talk through any, maybe you could take a specific sector, things that you think are most important drivers for a
Yeah.
particular token or sector that you keep an eye on your screens.
Yeah. So what I like to talk about is how in the equities world, there are all different ways to value stock. So if you're looking at a sector whose balance sheet is in play, you'll look at EV to EBITDA, enterprise value to EBITDA, because that reflects some of the balance sheet changes. If you're looking at a high flying unprofitable tech company, you're looking at a revenue multiple. If you're looking at like a more mature tech company, you're probably looking at a next 12-month PE. Every sector kind of has its own way of being valued, and the key is understanding what the other fundamentally driven investors are looking at, and then using that valuation methodology. In equities, you have some other things to help you and make the market more efficient, meaning you have a sell side, so Wall Street, that publishes estimates, and you can look at how stocks have traded versus Wall Street estimates on a forward looking basis over a period of time. We don't have that yet in crypto, but I think we'll have that down the road. So for us, it depends on whether you have a protocol that's generating revenue. If
Mm.
it's generating revenue, you typically want to look at a multiple of that revenue. Sometimes you make adjustments to that revenue. Sometimes you don't, based on whether revenue is flowing to the governance token, or whether it's just gross revenue generation. And there's some really good platforms for looking at these multiples. If it's a base layer, and they don't have revenue capture or material revenue capture today, what we found through the last bull market was multiples of TVL actually were very good indicators for how people were looking at valuation, and how we should think about valuation. But the interesting thing is, in bear markets, you often get changes in how people in valuation frameworks and what's important. So now that you have ETH with much lower emissions after the merge, with 1559 in place, so you have a burn of ETH based on activity. It's going to be interesting to see whether you start going to more of a revenue multiple on ETH, whether that starts to disadvantage other base layers that don't have as much revenue generation. My guess is that we're a little early for that, and we're not going to see that shift coming out of this bear market. But those are some of the things that we think about. For borrow lend, TVL tends to be the right way of thinking about valuation. For DEXs, it tends to be on revenue generation and on gross revenue generation, so gross fees rather than fees that are attributable to governance tokens, because you have a wide range of how much fee capture goes to the governance token, from 0 to larger amounts. So that's kind of a little look at what we're looking at.
Yeah, no, that's super helpful. And, from my background as well, we kind of crossed paths back in our earlier careers pre-crypto on, forward-looking estimates from the sell side. And so as you look at the pendulum swinging from a narrative-driven market to a more mature, fundamentally driven market, the ecosystem that supports that, when it comes to buy-side and sell-side research and all the analytics and information that can be tracked there, on a forward-looking basis, I think is super important. Because to your point, the beauty of crypto is that all of this data is available on chain, but that's in a real time and historical looking perspective. These assets don't trade, maybe they do somewhat on historical performance, but when you look at traditional markets, these are long duration assets. And so the value accruing to a particular token should be based off of what the forward looking estimates of that look like. Now, it's hard for you. I'm sure you're analysts, and I saw you guys are hiring ex equity research analysts to come, pivot into this space and bring those types of DCF, for lack of a better term, models. But the, benchmarking around that for, what is one fund versus another, what is the sell side versus the buy side, think on a particular key driver of a token going out 3, 5, 10 years just doesn't exist today. But as this industry continues to mature, you're seeing some more of the banks, like I was reading Bernstein putting out research on Ethereum. It's great to see that type of activity because that will increase the institutional adoption of this market, both from a trading, research, and valuation perspective.
It's really funny. So when you're on the equities investing side, there are a lot of people who say like, well, but the sell side estimates are never right. And it's like, it's not about whether the sell side estimates are right or not. It's about having this number that's a projection that's out there that everyone sees, and then everyone benchmarks to that. So if a company is expected to earn $1 of earnings for next year, and it's trading at its average multiple, and you think it's going to earn $1.20, well, then there's likely upside to the stock over the next year. If it's trading at a 20% premium to its normal multiple, and the consensus number is $1, then the street might already be pricing in that upside that you think is likely to come. So it's really important for benchmarking where the street expectations are versus where your expectations are. And we don't have that right now in crypto, which probably adds to some of the volatility that we see in the space. And we're going to get all of this infrastructure over time. And the more you get this infrastructure, the more efficient the market becomes, and the less opportunity there is for alpha generation over the long run. So we're happy having that emerge at kind of a nice steady pace.
I would imagine. Yeah, it's great to be, picking winners in a market that doesn't have a lot of clear benchmarks to trade against, as you're doing a lot of the, brute force analysis of going through and understanding the valuation, but also keeping an eye more towards, some of the narrative driven price action that maybe didn't impact your investment process before you came into crypto, but certainly does now. But yeah, it definitely creates an opportunity for investors that are here in the space to really deeply understand projects and where they're heading, that the market doesn't have a very clear vision of what the consensus looks like. And I think what's also interesting too is that you look at crypto versus like traditional equities. Traditional equities, there's the lack of standardization on like operating metrics, right? Everybody has their own adjusted EBITDA number or their own, unit economics that matter as you kind of like lift under the hood. But for crypto, a lot of that is already baked into the protocols and into the actual chains themselves. So you can see those numbers in a more comparable way than you probably would by digging through a bunch of equity research models from the sell side in, looking at Tesla, for example. So very
100%.
interesting.
Totally.
So yeah, I would love to, any other thoughts you want to share with the audience? This has been great. We've covered a lot of ground here. But yeah, would love to see if there's anything else you wanted to share with the folks on the call.
No, this has been awesome. I mean, as I alluded to earlier, we put out a call a few weeks ago that We really like what we see from the bottoming process. The fact that we've been now 7 months into that. There's been, one thing that we highlighted. There are a lot of questions around, was crypto just a beneficiary of the liquidity bubble, the
Mm.
everything bubble? And we showed the performance of crypto from June 5th of 2020, which is the date we used. It was when the NASDAQ got back to its high from before COVID, through to when we did the webinar. And crypto was up nicely. We looked at ETH and Bitcoin versus like Apple and the NASDAQ. And Goldman has an expensive expensive software index, and that was down. And we then went into, well, what are the drivers of those fundamentals? And it's a lot of the things that we talked about, right? The reason why, in our view, crypto has outperformed over that that bubble period, obviously went up a lot and then came down a lot, but still point to point up nicely, is because you've had this secular fundamental growth in exchange volumes, DEX volumes, NFT activity, stablecoin activity. We think stablecoins are one of the big product market fits that came into view in the last bull market. Massive increase in both stablecoins outstanding and stablecoin volumes on a monthly basis. So just a great story, from developers to activity to new verticals over the last bull market, that we think is the reason why crypto prices point to point through the liquidity bubble have held up really well, despite going up a lot and then coming down a lot.
Yeah, not only, I mean, the stable coins, not only has there been more understanding of the different designs and frameworks behind stable coins, but it's also kind of pushed out some of the more risky frameworks that, like a USDC does not follow. And then also, I don't know if you saw the news this morning, but Visa is looking at settling USDC on Ethereum. So seeing the,
Yep.
what the number one payment network processes trillions of dollars, retail and commercial payments on an annual basis, looking at settling payments in this space to allow, their issuers and merchants to be able to transact in USDC, things that have been building for months, years, and are starting to come to the surface, which is extremely exciting about where this whole industry heads. So
Super
completely agree
powerful.
with you on all of that. Yeah, super powerful. You want to talk about real world use cases in crypto? There you go. So, well, thank you, Seth. It's been a pleasure. Really appreciate the time, and we'll talk to you again very soon.
Awesome. Thanks, Jim.
And thanks everybody for joining Compound. Our Compound Thesis. We've got all of our episodes up on our YouTube and our Spotify and on our website, compoundtreasury.com/thesis. Thanks all. We'll be back again soon.